Hi, I'm Scott Olson, co-founder of LTCshop.com and author of Long-Term Care Insurance Now. This year, 2026, we're sharing 26 client profiles. These are not hypothetical examples. These are real people, real clients, real policies, real premiums, and real expert advice. A common misunderstanding about long-term care insurance is that the policies only cover a short period of care. I mean, every week I see posts on social media where somebody says, oh, long-term care insurance is limited. It only pays for a year of care or 2 years of care. Or somebody might say, well, it might pay for 3 years of care. What good is that? Well, that's not true. But if that was true, it still worked out for my mother-in-law. She had a policy with 3 years of benefits. She received $280,000 in benefits from the policy, and that ended up improving her net worth by $878,000. No joke. If you want to find out how we did that, I explained it in a podcast last month. Check it out if you haven't already. But long-term care policies can pay for a lot longer than a few years of care. Now, do some people buy only 3 years of benefits? Yes, some people do. But if you're very healthy, when you apply for a policy, you can buy more than just 2 years of benefits or 3 years of benefits. Most of my married clients buy at least 10 years of shared benefits. That's coverage that can help protect against a truly catastrophic long-term care experience. But as we've been discussing, there are even policies with no lifetime cap. In the past 3 episodes, I've talked about clients of mine who recently purchased long-term care insurance policies with no lifetime cap, no lifetime limit. In this episode, we're going to talk about Steve and Marilyn. Steve is 64. Marilyn is 66. Steve is an executive with a high 6-figure income. They have a very comfortable 7-figure net worth, and they plan on retiring in a year, maybe 2. They both have longevity in their families, and they both have a history of dementia in their families. They have a lot of experience with family members needing long-term care. Fortunately, both Steve's parents and Marilyn's parents owned long-term care insurance. So Steve and Marilyn saw firsthand how beneficial the policies were. Now, Steve has a cash value life insurance policy with a $250,000 death benefit. More importantly, his life insurance policy has about $130,000 in cash value. They don't need the life insurance anymore, but because of their family history of dementia, they want some long-term care insurance, and they would like to use the cash value in the life insurance policy to help pay for some long-term care insurance. Now, life insurance cash value grows tax-free until you take it out. Once you take it out, you have to pay ordinary income tax on the gains in the cash value. Since Steve and Marilyn are in one of the highest tax brackets, if they took the cash value out of the life insurance policy, they would end up paying over 33% of the gains in income tax. Fortunately, their financial advisor suggested they do a 1035 exchange. That means that the cash value would be transferred from their life insurance company to a special kind of long-term care annuity. Not any annuity can qualify for this. It has to be a special kind of long-term care annuity called PPA compliant. They would not have to pay any taxes on the life insurance cash value when the 1035 exchange is done. And if the annuity meets the requirements of the PPA, the Pension Protection Act, when the money is pulled out of the annuity to pay for long-term care, the benefits are tax-free. So with the 1035 exchange, they're able to turn taxable gains into tax-free long-term care benefits. So with my assistance, that's what we did. We transferred the cash value from the life insurance policy into a Pension Protection Act compliant annuity. However, they wanted the long-term care benefits to have guaranteed inflation protection. So they bought a 3% compound inflation protection rider. They also wanted the lifetime benefit period with no cap on how long they could receive long-term care benefits. So they added that rider as well to the annuity. The one-time premium for those two riders was a total of $90,000. They simply moved two of their smaller assets, a small CD, and the cash value from the life insurance, into another asset, the Pension Protection Act compliant annuity. The total deposit into the annuity was about $220,000. Now, what did that get them? Well, if they need care next year, they'd get over $51,000 of benefits per spouse, tax-free, for as long as one or both of them might need care. Plus, the monthly benefit is guaranteed to grow every year, even while on claim receiving the benefits from the policy. The monthly benefit is guaranteed to grow by no less than 3% compounding every year. Might grow by more. Because of the compounding, if they need care 15 years from now, for example, they'd receive over $88,000 per year per spouse in tax-free income. Again, with no lifetime cap on the benefits, no matter how long they might need care, they will never run out of long-term care benefits. What if they never need care? Well, if they are both lucky enough to never need long-term care, if, for example, they both passed away at age 90, well, their beneficiary is guaranteed to receive no less than $258,000 back. Is this annuity with a long-term care rider a good investment? No. Like I said in the last episode, it's not a good investment because it's not an investment. It's primarily an insurance policy designed to help protect their other investments from a catastrophic long-term care experience. And if they never need long-term care, well, great. Their beneficiaries will get back some of what they put into the annuity with a little bit of interest. What about their health? How much did their health impact which policy I recommended for them? Well, with this particular annuity, with a long-term care rider, the money that's put into the annuity is used to pay for the first 30 months of care. Because of that, the underwriting is very lenient. Steve and Marilyn had a lot of the more common health problems faced by people in their mid-60s. Thyroid issues, high cholesterol, high blood pressure, enlarged prostate, bunion surgery, squamous cell carcinoma, etc. The biggest concern, though, about their health histories was the family history of dementia. But again, with these types of annuities, the underwriting is very lenient for the reasons I just stated. There are a lot of annuities that are sold as a solution for long-term care. A lot of them are not so good. Most of them are not compliant with the Pension Protection Act. There are a few that are excellent and that do comply with the Pension Protection Act. If you've been given information about buying an annuity for the purposes of planning for long-term care, please reach out to me. Let me review it for you at no cost. In the next episode, I'm going to talk about another client, Rod, and his wife, Cassie. They did a 1035 exchange. They turned a $100,000 gain into tax-free long-term care benefits. They turned a $100,000 taxable gain into tax-free long-term care benefits using Pension Protection Act compliant annuity. Thanks.